First, the earnings available for distribution came at $145.8 million. Overall, the street is split down the middle on this one. Based on 5 buys and holds each, the stock X out a moderate buy consensus rating. Hello, my name is Marc Drouinaud Jr. Welcome to my channel. If you're new here, I do cyber-related videos. So, money, hey, money. I have 3 dividend stocks to buy, and they're 8% dividend yield or better. So let's talk about it. This is courtesy of Tip Ranks by Yahoo Finance. What's going on in the markets lately? Since the start of this year, we've seen a prolonged bearish trend, and now a cycle of high volatility. Investors can be forgiven for feeling some confusion or even some whiplash in trying to follow the rapid ups and downs of recent weeks. One important fact does stand out, however. Over the past 3 months, since mid-June, we've seen rallies and dips, but the markets have not seriously challenged that mid-June low point. Examining the situation from research from firm Fundstrat, Tom Lee makes some extrapolations from that observation. First, Lee points out that some 73% of the S&P listed stocks are in a true bear market, having fallen more than 20% since their peak. Historically, he notes that a percentage that high is a sign that the market has bottomed, and goes on to note that S&P bottoms typically come shortly after a peak in the rate of inflation. Which brings us to Lee's second point. Annualized inflation in June registered 9.1%, and in the 2 published readings since then, it has fallen off by 0.8 points to 8.3%. Getting to the bottom line, Lee advises investors to buy the dip, saying, or even for those in the inflationista camp, or even in the we are in a long-term bear camp, the fact is, if headline CPI has peaked, the June 2022 equity lows should be durable. Some of the Wall Street analysts would seem to agree, at least in part. They are recommending certain stocks as buys right now, but they are recommending stocks with high dividend yields on the order of 8% or better. A yield that high will offer real protection against inflation, providing a cushion for cautious investors. Those in the inflationista group, right? We've used the Tip Ranks database to pull up some details on these recent picks. Here they are, along with the analyst commentary. We have Rhythm Capital Corp, RITM. We're talking dividends here. So we'll start with the Real Estate Investment Trust, REIT. These companies have long been known for their high and reliable dividends and are frequently used in divisive portfolio arrangements, right? And they are frequently used in defensive portfolio arrangements. Rhythm Capital is the new name and branding of an older established company, New Residential, which converted to an internally managed REIT effective this past August 2nd. Rhythm generates returns for its investors through smart investments in real estate sector. The company provides both capital and services, that is, lending and mortgage services for both investors and consumers. The company's portfolio includes loan origination, real estate securities, property and residential mortgage loans, and MSR-related investments, with the bulk of the portfolio, some 42%, in mortgage servicing. Overall, Rhythm has $35 billion in assets and $7 billion in equity investments, right? The company has paid out over $4.1 billion in total dividends since it was first founded in 2013. And as of Q2 2022, boasted a book value per common share of $12.28. In that same Q2 of this year, the same operating as New Resai, the company showed 2 key metrics of interest to investors. First, the earnings available for distribution came at $145.8 million, and second, of that total, the company distributed $116.7 million through its common share dividend, for a payment of 25 cents per share. That was the 4th quarter in a row with the dividend paid at that level. The annualized payment of $1 gives a yield of 11%. That's more than enough in current conditions to ensure a real estate of return for common shareholders. RBC Capital's Kenneth Lee, who's a 5-star analyst, lays out several reasons why he gets behind the name We view RITM's available cash and liquidity position favorable given potential deployment in attractive opportunities. We favor RITM's ongoing diversification of its business model and ability to allocate capital across strategies and differentiated ability to originate assets. We have an outperform rating on our RITM shares given potential benefits to BVPS from rising rates. That outperform rating is backed by a price target of $12, suggesting a 1-year gain of 33%. Based on the current dividend yield and the expected price appreciation, the stock has 44% of potential total return profile. While only 3 analysts have been following this stock, they all agreed that it is one to buy, making the strong buy consensus rating unanimous. The shares are selling for $9 and their $12.50 average price target suggests an upside of 39% for the coming year. Next, we have Omega Healthcare Investors, OHI. The second company we'll look at, which is Omega, combines features of both healthcare providers and REITs. An interesting niche that Omega has filled competently. The company holds a portfolio of skilled nursing facilities, SNFs, and senior housing facilities, SHFs, with investments totaling some $9.8 billion. The portfolio leans toward SNFs 76%, with the remainder of SHFs. Omega's portfolio generated $92 million in the net income for the second quarter of 2022, which was up 5.7% from the $87 million in the year ago quarter. On a per share basis, this came to 38 cents EPS in quarter 2 2022 against 36 cents a year prior. The company had adjusted funds from operations adjusted FFO of $185 million in the quarter, down by 10% year over year from $207 million. Of importance to investors, the FFO included fund available for distribution FAD of $172 million. Again, this was down from quarter 2 2021, which was $197 million, but it was enough to cover the current dividend payments. That dividend was declared for common stock at 67 cents per share. This dividend annualizes at $2.68 and gives a strong yield of 8.4%. The last dividend was paid out in August. In addition to the dividend payments, Omega supports its stock price through a share repurchase program, and in Q2 the company spent $115 million to buy back 4.2 million shares. Assessing Omega's Q2 results, Stifel analyst Stefan Manaker believes the quarter was better than expected. The 5-star analyst writes, headwinds remain, including COVID's effects on occupancy and high costs, especially labor. But occupancy is increasing and should improve further, assuming no COVID relapse, and labor costs appear to be increasing at a slower rate. So we continue to believe the stock is attractively priced. It trades at 10.2x our 2023 AFFO. We expected 3.7% growth in 2023, and the balance sheet remains a source of strength. We also believe OHI will remain its dividend as long as the recovery continues at an acceptable pace, the analyst summed up. Manaker follows up his comments with a buy rating and a 36 price target that shows his confidence in a 14% upside on the 1-year horizon. Overall, the street is split down the middle on this one. Based on 5 buys and holds each, the stock X out a moderate buy consensus rating. Lastly, we have SFL Corporation. For the last stock, we'll turn from REITs and cover, and over to ocean transport. SFL's corporation is one of the world's major ocean transport operators with a fleet of some 75 vessels. The exact number can vary slightly as new vessels are acquired or old vessels are retired or sold, ranging in size from giant 160,000 ton Suez freighters and tankers to 57,000 ton dry bulk carriers. The company's ships can carry nearly every imaginable good from bulk cargoes to crude oil to completed automobiles. SFL's own ships are operated through charters, and the company has an average charter backlog into 2029. The long-term fixed charters from ocean carriers are big business, and in Q2 2022 brought in $165 million in net income. SFL reported $57.4 million or 45 cents per share. Of that net income, $13 million came from the sale of older vessels. Investors should take note that SFL's vessels have an extensive charter backlog, which will keep them in operation for at least the next 7 years. The charter backlog totals over $3.7 billion. We've mentioned fleet turnover, another important factor for investors to consider, as it ensures that SFL operates a viable fleet of modern vessels. During Q2, the company sold 2 older VLCCs, which is very large crude carriers, and 1 container ship, while acquiring 4 new Suez tankers. The first of the new vessels is scheduled for delivery in Q3. In Q2, SFL paid out its 74th consecutive quarterly dividend, which is a record of reliability that few companies can match. The payment was set at 23 cents per common share, or 92 cents annualized, and had a robust yield of 8.9%, right? Investors should note that this was the 4th quarter in a row in which the dividend was increased. DNB's 5-star analyst, Jorgen Leon, is bullish on this shipping company, seeing no particular downside, he writes. We believe there's considerable long-term support for the dividend without considering any potential benefit from the strengthening offshore markets. If we include our estimated earnings from West Hercules and West Linus, the potential for distributable cash flows have approached USD 0.5 cents a share in our view. We see ample upside potential, while the contract backlog supports the current valuation. Lion puts his view into numbers with a $13.50 price target and a buy rating. His price target implies a 1-year gain of 30%. Some stocks slip under the radar, picking up few analyst reviews despite sound performance, and this is one. Lions is the only current review on record for this stock, which is currently priced at $10.38 a share. Thank you for watching this video. I appreciate you. Have a great rest of your day. Please subscribe. Please hit the notification bell. Bye-bye.